All right, let's talk about derivatives. This is easily one of the most powerful, most enormous, and, let's be honest, most misunderstood concepts in the entire world of finance. So what are these things really?
Well, when one of the smartest investors on the planet, Warren Buffett, says something like this, you kind of have to pay attention. Weapons of mass destruction? I mean, that sounds absolutely terrifying, doesn't it? This one quote really sets up the big question we're going to explore. Are derivatives incredibly dangerous, incredibly useful, or somehow both?
But before we get too carried away with all that, let's just strip away the jargon and start with a super simple definition. A derivative is just a financial contract whose value is derived from something else. That something else is what we call the underlying asset. Now that could be anything, a stock, a currency like the dollar, the price of oil, you name it. The big idea here is that a derivative's value isn't its own thing. It's always linked to the value of something else.
Now that definition is okay, but it's still a little abstract, right? So let's make it real. Let's look at a concrete, real-world example of how, and more importantly, why someone would ever use a derivative in the first place.
So picture this. You're an exporter based in India, and you know you're getting paid $1,000 next month for some goods you sold. Now, here's your problem. You have no idea what the exchange rate is going to be then. If the dollar gets weaker against the rupee, your payment is suddenly worth less. So what do? Well, you can use a derivative. You can go to a bank today and sign a contract that lets you sell those $1,000 in 1 month at a guaranteed rate, let's say 80 rupees per dollar. And just like that, you've locked it in. You've used a derivative to completely eliminate your risk. The value of your contract is now directly tied to or derived from that future exchange rate.
Okay, so that contract our exporter used is one type of derivative. But here's the thing. While there are tons of different variations out there, they pretty much all fall into one of two big families. And the difference between these two is absolutely everything.
On one side, you have things called forwards and futures. The best way to think about these is like a pinky promise you absolutely cannot break. It's an obligation. Both sides have to go through with the deal at the price they agreed on. That's what our exporter did. But then, on the other side, you have options. And the name says it all, right? An option gives you the right, but not the obligation to buy or sell something. You have the choice. You can walk away. This distinction between a promise you must keep and a choice you get to make is the fundamental building block of the entire derivatives world.
And you might think this is all some newfangled Wall Street invention, but no way. These ideas are ancient. Seriously. The first recorded use of something like an option was way back in ancient Greece. A philosopher named Thales thought the olive harvest was going to be huge, so he paid a small fee for the right to use all the local olive presses. The harvest was massive, demand for presses went through the roof, and he made a fortune selling his rights. From there, you see derivatives pop up with tulip bulbs in Holland, then with farmers in 19th century Chicago, all leading up to the birth of the modern options exchange in 1973.
All right, so we know what they are, and we know they've been around forever. But who's actually in this market, and what are they trying to do? Well, you can usually break it down to three main types of players, each with a totally different motive.
First up, you've got the hedgers. Our Indian exporter was a classic hedger. They have a real-world risk they want to get rid of, so they use a derivative, kind of like an insurance policy. They are totally risk-averse. Then you have the speculators. These folks are the complete opposite. They aren't trying to reduce risk, they're taking it on. They're simply placing a bet on where they think a price is headed. They are risk takers. And finally, you have the arbitrageurs. These guys are like the detectives of the financial world, hunting for tiny little pricing mistakes between different markets so they can lock in a guaranteed, risk-free profit. They are risk eliminators. You actually need all three for a healthy market.
Okay, so we've got these powerful tools and the different players who use them for different reasons. Now let's pull the camera back and really appreciate the scale of all this, because we are talking about one of the largest financial markets on Earth.
Yeah, you're seeing that right. $128 trillion. It's a number so big it almost loses all meaning. And get this, that's not even the whole market. That's just the estimated value for one part of it, the over-the-counter market. It just goes to show you how deeply embedded these instruments are in the very fabric of the global economy.
So what in the world makes up a market that big? Well, you might be surprised. Take a look at this chart. The main event here isn't stocks. The huge majority, a whopping 70%, is all about interest rates. The next biggest slice, at 14%, is foreign exchange, currencies.
So what does that tell us? It tells us the primary use of derivatives on a massive global scale is for big corporations and banks to manage the risks that come with shifting interest rates and currency values.
And all this trading happens in one of two main places. You've got your exchange-traded derivatives. Think of these like buying something off the shelf at a store. The contracts are standardized, they're traded on a public exchange, and that exchange guarantees the trade. So there's almost no risk that the other person won't pay up. And then you have the over-the-counter or OTC market. This is more like getting a custom-tailored suit. It's a private deal made directly between two parties. It's way more flexible, but it does carry a bit more risk because there's no central party guaranteeing the deal.
And all of this brings us right back to where we started. When you have a market this large, this powerful, and this complex, are these instruments beneficial tools for managing risk? Or are they the financial weapons that Warren Buffett warned us about?
It really is a tale of two competing views. On one side, you have the Buffett camp. Their argument is that derivatives can be used to hide risk, to create these ticking time bombs of leverage that can blow up. But on the other side, you had people like former Fed Chair Alan Greenspan, who argue that derivatives are vital, that they help spread risk throughout the financial system, which actually makes it more stable. This is the fundamental debate.
So here's the bottom line, the most important thing to get. Derivatives themselves aren't good or evil. They're just tools. Really, really powerful tools. And that power can be used by a hedger to protect their business and make the economy safer. But that exact same power can be used by a speculator to take on an insane amount of leverage and make a crazy bet. The instrument is the same. It's all about the intention of the person using it. Which leaves us with a big question to think about. In our incredibly complex global economy, are derivatives an absolutely essential part of the toolkit? Something we just can't live without to manage risk? Or have we created a source of systemic risk that's just too big and too interconnected to ever really control? The real answer, as always, is probably somewhere in the middle. But figuring out where you stand on that question, well, that's the first step to really understanding how modern finance actually works.